you about that and you told me and I forgot. Do you remember what the issue was that this was included with on the ballot?
Oh. Part of it was, I want to say, campaign financing disclosures.
Something like that.
There was something
I was
else.
curious about. Anyway, I would just like to, and I talked with St. Johnson for this. Originally, we had it for everything, not just tax, but also contributions to politicians. And that's where the $700,000 number came from. That was initially how it was evaluated. And I think if there is a motion, at least I'm not going to make it. If somebody wants to make it, I think Representative Dodson and I both agree that it should be that way again. When we start looking at exemptions to get rid of, I can't think of a better one than get rid of people donating to politicians. That's just me. Representative Dodson, you want to comment?
I agree, and I would make a motion to change this slightly to include the entire tax credit. So my motion would be to repeal the political contributions income tax credit for contributions to candidates and campaign and PACs.
Is there a second?
Second.
Okay. Any other discussion? All in favor say aye.
Aye.
All opposed? Motion carried. Representative Johnson, you want to comment?
I just want to say that I voted no because the realtors, all the realtors in Arkansas, I think, donate to their political action committee, and they support a lot of candidates. And so I support my realtors.
Okay. We're to item number 30.
Income tax proposal number 30 would create an optional tax-through entity tax. And the purpose of this is to increase the fairness between owners of C corporations and owners of pass-through entities as it relates to their ability to deduct their state and local taxes from their federal income tax. Under the new federal tax law, the Tax Cuts and Jobs Act, it limits the SALT deduction for individual filers to $10,000. So under that, a C corporation can take an unlimited SALT deduction, whereas owners of pass-through entities are limited to $10,000. This proposal would allow a pass-through entity to pay their Arkansas income tax directly to DFA in the same manner as a C corporation, which would allow them to take the SALT deduction under federal law in the same manner that a C corp would. This proposal is intended to be revenue neutral, and it's intended to minimize the procedural changes and additional responsibilities for DFA. And the proposal indicates that it would be designed according to the guidance received from and the requirements of the Internal Revenue Service. DFA stated that there would be no tax revenue cost. However, implementing the proposal would require some additional staffing and computer programming. The additional employees and processing costs would be approximately $500,000 per year, with an additional cost for programming to create a new tax type in their system.
Okay. Representative Jett, you want to comment on it?
Yes, thank you, Chair. Remember, basically, this allows business owners to continue deducting state income taxes and put $10,000 back in. They have a choice to how they want to reinvest their capital back into the business.
Okay. So you make a motion?
I do, and the two is more than one.
Okay. Is there a second?
Second.
Absolutely. Okay, Senator Dismayne, you recognize.
Thank you, Mr. Chairman, and I just want to, so the proposal is that you're going to tax them at the Arkansas corporate rates at the entity level? And how do we know that's going to be? Those rates are different than the individual income tax rates, and so how do we get to knowing that that's a fairly complicated equation to get revenue neutral as a non?
Well, certainly, Senator Dismayne, many of the details will have to be ironed out exactly how this is going to work, but certainly, you would want to mirror the tax rates that are available for corporations and for individuals, so as to not establish a method so that you can organize in a certain way to get the lower rate.
So you see this to be an election, so you can either elect to be taxed at the entity level or at the individual level after the pass-through occurs.
Yes, it would be in the form of an election.
Walk me through one more time kind of how this jives with the federal law. I mean, I understand limitations of the federal law, But how does this get us in compliance with federal law?
Well, certainly, this is a proposal that was brought to DFA for, to review and provide feedback. And certainly, it might be the proponents of the matter that can best explain how this would work. In case they're present here today.
Go ahead.
There's certainly, other states have brought approaches into their general assemblies to
Yeah, I mean,
formulate some type of mechanism, and certainly those states have weighed in, the IRS has weighed in to consider, and ultimately, we would have to make sure that any proposal would be okay with what the Internal Revenue Service would want to authorize as an appropriate package.
Okay, Tim, you all would identify yourselves for the record and try to clarify some of the questions here.
Yes, Mr. Chairman. I'm Tim Leathers with Veritas, and I have with me Jennifer Bell with Bell and Company, who introduced before as a CPA and a lawyer, and this idea comes from her dad, their CPA firm, Bell and Company. And she can explain the details for you and the mechanics of how it would work.
Can y'all repeat the question again? I'm
Yeah,
not
so
sure.
I just want to understand how this is all, and by the way, so, but if we, I just want to make sure I understand how this is going to get us in compliance with federal law, because there's not this, taxation at the entity level on the federal side, but there's not.
There is for C corporations,
C corps,
right?
but not-
And I'm not trying to make a pass-through entity into a C corp. That's not what we're trying to do.
Right.
We're trying to get on level footing. So it would be elected, think of, and I don't know how many of you do maybe out-of-state composite returns, right? If you operate in multiple states. You can pay the out-of-state withholding amount at the entity level and either deduct it or take it as credit, right? Same principle. It's just you're paying it at the entity level. You're going to deduct it as an ordinary and necessary business expense on the federal side, but when it comes to the pass-through to the individual owner, it's going to basically be an offset dollar for dollar on the state taxes due.
Yeah, so if you own real estate, you have real estate holdings, and this is, in my opinion, it's probably going to impact more than anyone else, because those individuals pay real estate taxes, and those real estate taxes, if they carry through to a Schedule A, for instance, on their return.
They shouldn't though, because it'd be ordinary.
Well, in the past. So, if it's a holding, it's an investment expense, it's real estate, it goes to Schedule A, they're limited to
$15,000.
the punitive deal that we had in the past. That's gone, but now we have this soft limitation in place, which then kind of nets it out, really. But we're saying that we're going to allow that deduction for that investment type income, so real estate taxes, investment tax, or expenses, whatever mess that have been tied to holding in the past, is going to be deducted at the entity level. It's not going to be able to be phased out by the time it gets to the state income tax return.
It's income tax only that we're talking about, and let me just throw one more thing at you, I know that.
No, I know.
Yeah,
what
but
we're talking
but
about,
it's at the
taxes
federal.
that you pay.
Right. It's
That are
just
not
gonna
income taxes, but you want to be able to deduct them against the income that you're calculating to pay taxes.
right, but let me throw this at you real quick, okay? With the new tax reform, right, there's that qualified business income deduction, right? So let's say we take that income, and just to keep it simple, you get to take 20% of that as a deduction before you start calculating the tax, right?
On manufacturing.
Right, exactly, or on your real estate. So I'm just throwing this out there. That's going to reduce what that qualified business income tax deduction number comes out to. So when you really run the numbers, and being the nerd I am, I run the numbers, it's not a huge dollar differential. I mean, it is beneficial, but, with the new tax reform, there's a lot of things that are going into play. You can't just look at the state income tax being the only factor.
Right, no, I agree with that.
If I might say something that would be helpful here, if this same entity owns the property and is paying the property taxes, they will deduct that as an ordinary necessary business expense
under the new law, if that entity owns it, if they're owning it individually in their name, they'll be subject to that $10,000 limitation.
I would debate that with you, but I don't want to drag anyone else to the weeds of that. It depends if it's income producing or it's holding, and there's a lot of other factors to go into determining whether or not you can deduct it against ordinary income.
Right.
But,
What
I guess, how do you see this working? I mean, so you've run the numbers, and so if we use the corporate taxation at the entity level, and we allow these, for these deductions, how do we understand that that's a wash? Does that make sense?
So I ran the numbers actually using 6% is what I ran the numbers out. Because that's what Governor Hutchinson has mentioned, he wants to reduce the Arkansas individual income rate down to the top bracket. So I use 6%, right? What Tim and I have even pitched around is, use the 6%, use the 6.5%, but at the end of the day, it's going to pass through to that individual shareholder, and whatever the entity is paid in on their behalf, it's going to basically be an offset to what is calculated on their individual return. Yes, it's just a deduction on the federal side.
Okay, Representative Johnson, you recognize.
Thank you. So this deduction that we're taking on that we're paying to the state would also be on our federal, and lower our pass-through amount to the federal?
The qualified, yes, it would, yeah.
Right, and then we would get a credit to the individual shareholders or members of the LLC for the amount that we pay, the corporation or LLC pays on our behalf.
Correct, just like a composite.
Okay. I think that, it does seem revenue neutral. It's a little complicated. Our software writers are going to love it.
Absolutely.
You'll get the last of your turn here. So, okay, thank you, Mr. Chair.
Okay, that's all we have in the queue. We've got a motion and a second. All in favor say aye.
Aye.
All opposed? Motion carried. Okay, members, we're going to go till 11:30, and we're going to break for lunch. So let's try to get a couple more of these knocked out. We're on the property tax section now, so number 2. Joy.
Property tax proposal number 2 would create a non-refundable income tax credit equal to the amount of property tax that a taxpayer paid on business inventory. There would be a carry forward period of 10 years. This tax credit would be mutually